Hi, it's Brian Decker with your Market Minute. Going to cover a couple of things. First of all, on the market trend right now, it's being held up by four pillars in the market. The first is Fed accommodation. And as long as the Fed is accommodative and keeps rates low, people would rather go for a dividend of 2 or 3% that's higher than the Treasury rate right now, which is 1.6, 1.7. So the money will always go where it's treated best. And right now, that's the stock market over the Treasury rate. So Fed accommodation is one of the pillars. The second is the vaccination rate. The vaccination rate, as of this morning, President Biden said that he's moving up to April 19th, the day when vaccinations are open for everyone. And so the vaccination rate is going along splendidly. And the third pillar is economic recovery. So the ISM reports, the different economic reports are coming in strong. Jobless claims were lower than expected. The jobless gains, the job report on Thursday that came out on Friday, actually, when the market was closed, was better than expected. And so the economic recovery is going very well. And the fourth pillar in this economic recovery is the stimulus. So we passed 1.9 trillion. Now there's 4 trillion right behind it of build better on the infrastructure. And that hasn't been passed yet, but reconciliation is being tossed around. And so the markets are taking it as that this is going to happen. Now remember, in 2008, some on Wall Street threw a fit over 800 billion, and that created the Tea Party over frustration about the debt. We've just gone through 6 trillion in stimulus. So how long will Wall Street ride that wave, and how long will the Fed accommodate or be able to accommodate? The canary in the coal mine here is the Treasury yield. As long as it's below 2%, the Fed says that they're not going to taper or raise rates. I wanted to raise one other point that was interesting is in a good market, we've had two implosions of hedge funds. And I'm going to look at some notes on this because this is kind of interesting and I wanted to pass this along. Archegos Capital Management, second time in 2021, imploded after they had a margin call last week, actually 10 days ago, a week and a half ago. Viacom was one of the positions that went from 95 to 45 in a week. Discover went from 66 to 35 in a week. Baidu went from 250 to 200 in a week. And what happened is the hedge fund was thought to have 5 billion in exposure, actually had 30 billion in exposure. And here's the background that I found so interesting. Credit Suisse, Nomura, Goldman Sachs, and others had what are called contracts for differences, CFDs. These are what Warren Buffett called, he called them weapons of mass destruction. And here's why. When you take out contracts for differences, CFDs, you have massive leverage of 2 to 5%. So you can take down 100 million of Apple stock with Credit Suisse and place 2 million to hold that position, $2 to $5 million. And then you can call another bank, Nomura, and take down another 100 million of Apple, and neither one knows about the other's position. No one knows what your full position is, and you hold that with huge leverage. Now, Nomura took a massive hit in their own earnings because they took that loss, and the bank went from $725 a share to $625 a share in a day. Now, this is in a good market. I wonder what's going to happen in a bad market. It remains to be seen, but know about CFDs, contracts for differences. That is multiples of a typical margin of 2 to 1. This is 50 to 1 margin. And that's what caused the Archegos Capital implosion of 10 days ago. So it's Brian Decker signing off. Hope you had a great Easter last weekend. And we'll talk to you soon next week.